And our special guest is Telstra Chief Executive Andy Penn. Well, let's go there. Our stock of the day is Telstra, and it's reported its full year profits have dipped 4.6% to $1.8 billion. Total revenue and earnings both falling, however, still well within expectations. And the telco giant still managing to lift its dividend for the first time in 7 years. Shareholders will get 8.5 cents a share, taking the full year dividend to 16.5 cents. Looking ahead, the company expecting growth in FY23 with income expected to be between $23 and $25 billion. Well, off the back of those results, Chief Executive Andy Penn joining us now live. Andy, terrific to have you on the show. Thanks for joining us. How would you describe the result?
Look, thanks very much. It's great to be on the show. And FY22 for us is an inflection year, and it's a really important year because it's the year in which we see the last of the economic headwinds as a consequence of the migration to the NBN. And so to your point, whilst on the one hand our income, Ebitda and net PAT was down 5%, actually our underlying Ebitda was up 8.4% to 7.3 billion, and underlying earnings per share was up almost 50%. And that's why the board has the confidence in the future with our growth aspirations for next year and over the next few years to send a signal to the market to lift the dividend today for the first time in 7 years, I should say.
Yeah, indeed. So obviously rewarding shareholders there by lifting that dividend. So you're saying you are confident despite those headwinds that we're seeing in the economy at the moment?
Yeah, absolutely, because you see that the guidance for us this year was, for FY23 is 7.8 to 8 billion. That's off the back of 7.3 billion this year, and our outlook or our ambition, if you like, for earnings per share is high teens growth between FY21 and FY25. So, we've put in a lot of work over the last few years with what we call our T22 strategy, taken out about a third of our cost base. We've radically simplified the company. We're separating out our infrastructure assets, and that work's all pretty much done now. And so we get to see the benefit of the growth that comes. And of course, whilst we live in a more uncertain world, the one thing's for sure is that digital adoption is only increasing.
Yet I noticed just as far as your guidance is concerned, as articulated by your successor, estimated FY26 Ebitda will be significantly lower because of cost inflation and changes to customer demand profiles there. Obviously, just as far as impacts there on construction, also fibre supply.
Yeah, look, Andrew, that comment was in relation to one specific project, the Intercapital Fibre project that we announced earlier in this year, about $1.4 to $1.6 billion investment. But our outlook for Ebitda is for growth in mid-single digits between here in 2025. So yeah, sure, we are seeing some of the impacts on the economic environment on us, but they're relatively muted, and we do have some natural hedges in our business. So if you look at the total result of the company, we're on a very good trajectory.
How are you looking at your earnings growth, particularly when you separate them from your mobile business to your fixed consumer and small business?
Well, obviously the transition to the NBN has had the most material impact on the fixed business. Pleasingly, we saw our consumer and small business fixed business grow between the first half and the second half, and we'd said we thought that had bottomed out in terms of that impact, and that has been the case. On the enterprise side, we're still seeing declines in the data and connectivity business, but encouragingly, that was more than offset by 152 million of growth in our NAS business, which is fantastic. And our mobiles business just had a stellar year. Ebitda in our mobiles business was up 700 million, and across prepaid, postpaid, wholesale, we added best part of 750,000 in new services. So fantastic performance.
So Andy, with your T22 strategy, you're seeking to capitalise on that movement to, I guess, post-COVID hybrid working. Are you seeing then that there's a permanence about that?
Yeah, no, look, absolutely. We've seen both the demand for data increase, but also the type of use and how people are using their digital connections these days are increased. We've all learnt through COVID that we can work effectively and study effectively from home. We've had to completely reconfigure our networks to respond to that. We're doing TV interviews over this one's over Skype, or we could be using Zoom or Teams or otherwise, and We've adapted all of our networks to respond to that, but we're just seeing increasing demand for digital connection, but also digital solutions. I mean, for example, at the same time, we're seeing the level of malicious cyber activity increasing. So our cyber and security services, that's increasing. Similarly, our cloud business is increasing as well. So it's an exciting time for us, notwithstanding obviously some of the uncertainties around the economic environment.
Yeah, particularly as far as those security issues, I guess that is going to increase costs. I think we're seeing that across the board for businesses at the moment. Overall though, just as far as costs, underlying fixed costs down, total operating expenses down. Is there more room to cut costs at this point?
Yeah, well, look, we've taken out in our T22 program on an annualised basis $2.7 billion of fixed costs. That's somewhere just a bit over a third of our total cost base. So that's been pretty material. And then in our T25 strategy, which basically takes us out over the next few years, we are targeting to take out another 500 million. And that's notwithstanding the fact that we've been growing the business at the same time. And the reason that we've been able to do that is we've radically simplified the business and we've completely swapped out our digital systems and we've upgraded all of those. And so we're seeing, the number of transactions. So, for example, our consumer business, nearly half of all new business transactions and services are done online. More than 3/4 of all service interactions are online. That's enabled us to reduce the number of calls coming into our call centre by 70%. We brought our call centres back onshore. We brought our Telstra stores back in-house. And so, the company is in a much leaner, much more agile, much more simplified, much more digitised state, and so really well positioned for this next exciting phase of technology innovation.
So you're expecting gross debt to continue to decline then?
Well, we've got a very clear set of balance sheet settings, and we will operate within those. Our sort of net debt to Ebitda ratio is just under 2 points, so our gearing's in a strong position. That will increase a bit in 2023 as we basically book the debt that we've taken on in partnership with the Australian government to fund the Digicel acquisition. But we will continue to focus on having a very strong balance sheet.
Andy, you have increased guidance for capex. Can you give some indication as to where you're likely to deploy that money?
Yeah, no, absolutely. Well, earlier in this year, we announced a major upgrade and extension to our intercapital fibre networks. In other words, put that sort of in layman's terms, it's basically the backbone telecommunications infrastructure that connects the major cities around the country, and then also it's got on and off ramps to regional centres as well. And of course, as we're all doing more stuff online, we're sending more traffic over those networks. And of course, the other thing that's happening is that more and more people are putting more and more of their IT systems in the cloud. And so the hyperscalers, so people like Microsoft, just signed a major anchor tenant deal with them for this new intercapital fibre. They're looking to upgrade the amount of capacity they need. And so that's where that investment's going. The other thing we're doing is interesting satellite technology is really advancing as well. And we've done a deal with Viasat, which is a world-leading satellite company, to build all of their ground station for their Series 3 new satellite, which is going up over the next 12 months or so, which will cover the whole of Asia Pacific, but all of the ground station work is here in Australia. So some really exciting investments. And if you like, Andrew, it sort of it supports our decision to separate out our infrastructure business because there is so much demand for infrastructure assets from an investment perspective.
Well, further to that, the sale of Infraco, the proceeds from that, are you looking at perhaps capital returns or perhaps another buyback for shareholders?
Well, look, we, as you know, we're effectively, there's two parts to our infrastructure business. There's that which supports the mobiles business. That's essentially mobile towers and mobile huts. And then there's the fixed infrastructure. We've already entered into a partnership with the Future Fund on the mobile side. We call that Amplitel. And we sold 49% to them, and we used 1.35 billion of those proceeds to fund a buyback. It valued that part of the business at about 5.5 to 6 billion, by the way. To put it in context, our fixed infrastructure business, in terms of Ebitda, is about 6 to 7 times the size of our mobiles one. We said today that we will be putting out a scheme booklet, explanatory memorandum, at the end of this month, and there'll be a shareholders meeting to finalise the restructure of the business, and that will then provide the company with the opportunities to really optimise the value of that business going forward. But no decisions have been made yet in relation to that monetisation.
Andy, on a personal note, you are leaving next month. You've presided over your last earnings results here. You're obviously confident. You've left the business in a good space as you leave. What's your legacy? What are the most significant changes you feel as though you've made, and do you have any regrets?
Oh, plenty of regrets. Most of the regrets, by the way, are not being bold enough and not moving fast enough, as opposed to the things that we have done. I'd say a couple of things about my legacy. I remember when I was appointed the CEO back in 2015, I had a vision to create a world-class technology company that empowers people to connect. It wasn't about becoming Google. It was about recognising that telecommunications is very much now deeply in the technology space, and we needed to fundamentally transform to be successful. When I announced that vision, candidly and understandably, a lot of stakeholders thought it was implausible just given the scale of what we needed to do. And so the first thing I'm very proud about is stepping down in a month's time knowing that is what Telstra has become. And then the second thing I would say is that, strategies come and go, business changes, new competitors arrive, regulations change. Ultimately, the thing that you want to leave from a lasting legacy point of view is the people, the culture, the motivation, the level of engagement, your ability to attract great talent, because that's what's sustainable. And, I'm just really proud that our culture's in a great place. Employee engagement has never been higher. We've appointed my successor and her successor as the CFO, both from within the senior management team. And, it's a really great team, and that's what I'm proud of.